Imagine trusting someone so completely, they become the bedrock of your financial future. Imagine that person, a pillar of Wall Street, a pioneer secretly building a lie so vast, so audacious, it would swallow $18 billion in real money and vaporize $64.8 billion in phantom wealth. This wasn't a market crash. This was a deliberate, decades-long betrayal by one man, Bernard Madoff, that devastated 37,000 lives across 125 countries. And the most shocking part? He didn't even need to do it. Bernard Madoff. The name once evoked trust, innovation, and an almost mythical touch on Wall Street. In 1960, he founded Bernard L. Madoff Investment Securities LLC with just $5,000. From that modest beginning, he rose to become a true pioneer in electronic trading, a force so respected he served as chairman of the NASDAQ stock exchange in the early 1990s. He was an institution, a financial guru who seemed to possess a unique insight, consistently outperforming the market even in turbulent times. He was, to all appearances, the epitome of American financial success. Madoff didn't just manage money. He cultivated an air of exclusivity, a whispered secret among the elite. You didn't simply invest with Bernie. You were invited. His firm wasn't openly advertised. Access was granted through a secretive network of feeder funds and word of mouth. He promised incredibly consistent, almost unbelievably high returns, often 10 to 15% annually, month after month, year after year, even when global markets stumbled. While others struggled, Madoff's clients saw steady, predictable gains on their monthly statements. This wasn't just about financial prosperity. It was about status, about being part of an elite, privileged club. Celebrities, wealthy families, major charities, even other investment firms. Everyone clamored for a piece of Madoff's seemingly infallible magic. But here's the devastating, soul-crushing truth. There was no magic. There were no groundbreaking investment strategies. There were no actual trades for his advisory clients. Bernard Madoff's entire operation was a classic Ponzi scheme, meticulously perfected and expanded on an unprecedented, terrifying scale, believed to have begun as early as the 1980s, possibly even the 70s, when investors handed over their hard-earned money, their life savings, their inheritances, their charitable donations. Madoff didn't put it into stocks or bonds. He simply deposited every single dollar into a single business account at Chase Manhattan Bank. And when an older investor wanted to withdraw their profits or principal, Madoff paid them out using money from newer investors. All those impressive monthly statements showing consistent gains, those detailed trade confirmations, every single one was entirely fabricated. A small, loyal team, isolated in a secret office within his own firm, worked tirelessly to create a universe of make-believe, printing fake trading records, creating false account balances, and forging documents to maintain the illusion. It was a lie built on paper, sustained by trust, and powered by incoming cash. For years, this colossal empire of deceit stood unchallenged, a shocking testament not just to Madoff's cunning, but to blind trust and catastrophic regulatory neglect. But not everyone was fooled. As early as May 2000, a brilliant financial analyst named Harry Markopolos, looking at Madoff's impossible, steady returns, immediately recognized the hallmarks of fraud. He tried repeatedly, for nearly a decade, to warn the Securities and Exchange Commission, the SEC. He submitted detailed, meticulously researched analyses, outlining exactly why Madoff's numbers were mathematically impossible, why his strategies defied all logic. But the SEC, the very agency tasked with protecting investors and upholding market integrity, astonishingly ignored him. Time and again, they dismissed his warnings, even after multiple in-person meetings. Madoff himself would later express utter amazement at their incompetence, marveling at how a fraud so vast, so obvious to an outsider, remained hidden from the very watchdogs meant to stop it. It was a failure that would haunt thousands. The carefully constructed house of cards finally began to tremble in late 2008. The global financial crisis hit, sending shockwaves through markets worldwide. Suddenly, Madoff's clients, many facing their own liquidity crunch, desperately needed their money back. Massive withdrawal requests, totaling an unprecedented $7 billion, poured in. Madoff, who had boasted $5.5 billion in his bank account just months earlier in mid-2008, saw his reserves dwindle to a mere $234 million by late November. The well was dry. The lie, after decades, could no longer be sustained. On December 9, 2008, Madoff, cornered and out of options, confessed the devastating truth to his sons, Mark and Andrew. They, in turn, reported their own father to federal authorities the very next day. On December 11th, Bernard Madoff, the revered Wall Street titan, was arrested. The invisible billions, the phantom wealth, finally vanished, exposing the horrific reality. The fallout was an unimaginable catastrophe, a financial earthquake that rippled across the globe. 37,000 people across 125 countries, from the extremely wealthy to countless ordinary families, retirees, and charitable foundations, lost everything. Holocaust survivor and Nobel Peace Prize winner Elie Wiesel and his humanitarian foundation lost a combined $27 million. Wiesel described Madoff as one of the greatest scoundrels, thieves, liars, criminals. Hollywood actors like Kevin Bacon, Kyra Sedgwick, and John Malkovich saw millions vanish, along with other notable figures and institutions. But the true tragedy lay in the lives of everyday people. Imagine Norma, who, just 2 weeks after her husband's death, discovered her entire life savings and her disabled son's trust fund were gone, all based on Madoff's false assurances. Her surviving husband fell into severe depression. The betrayal was so profound, so absolute, that French aristocrat René Magin de la Villehutchit, a prominent investor who lost $1.4 billion, died by suicide. Madoff's own son, Mark, unable to escape the crushing weight and public shame of his father's crime, also tragically took his own life exactly 2 years after the arrest. Retirement funds decimated, charities unable to continue their work, universities stripped of endowments. The scheme wasn't just a financial crime. It was a crime against trust, against hope, leaving a trail of shattered lives, broken dreams, and unspeakable despair. Bernard Madoff pleaded guilty to 11 federal felony counts and was sentenced to a staggering 150 years in prison, where he died in 2021 at the age of 82. But his legacy endures as a chilling, cautionary tale, a stark testament to human greed and the devastating power of blind faith. It exposed not only the depravity of one man, but also the colossal, almost unfathomable failures of regulation, the inability of the SEC to protect the very public it was sworn to serve. And perhaps the most unsettling detail of all, Madoff didn't need the Ponzi scheme. His legitimate market-making business, the one he started with $5,000, was highly successful, earning him millions annually and pioneering electronic trading. Yet he chose to build this elaborate, cruel deception. Even in prison, the man reportedly cornered the market on hot chocolate, buying up all the supply and reselling it to fellow inmates at a higher price. A final, petty echo of his manipulative nature. The Madoff fraud remains a potent reminder. If returns seem too good to be true, if they defy all market logic, they almost certainly are. It compels us to question, to scrutinize, and to remember that behind every number, every investment, there are real people, real lives, and an immeasurable cost when trust is shattered. How many more invisible frauds are out there, waiting to be exposed?